You know, there are exactly 6 dates every single month that move markets more than almost anything else out there. Miss them, and you are literally trading blind on the days that actually matter most. So in this explainer, we're going to crack the code on macroeconomic data. Okay, let's dive into this. 6 dates. If you know exactly when these hit and you know how to actually read the data, you're going to see these massive market-moving surprises coming way before your neighbor even opens up their news app. But hey, before we can map out that calendar, we really need to master the data itself, right? Because every single time a new piece of economic data drops is really just there to answer one central mystery. And that is, what is this data telling us about the timeline? Like, is this new information telling us what's about to happen, what's happening right now, or what already happened? Figuring out that difference, that is absolutely the ultimate secret to getting ahead of the curve. All right, section 1, the framework, sorting the data buckets. So to solve this timeline mystery, we need a sort of decoder ring, something that sorts all this economic noise into 3 distinct buckets. Our very first bucket, leading indicators. I want you to think of these like your early warning radar. Data points like housing starts and building permits, they fall right into this category. They're out there signaling what's coming in the economic weather way before the storm actually hits. So if you want a heads up on exactly where the market and the broad economy are heading next, well, this is the bucket you've got to watch closely. And taking a look at this, it brilliantly illustrates that exact difference. While leading signals, like those housing starts, are busy looking toward the future, lagging indicators, like the unemployment rate, they only actually change after the whole trend has already shifted. It's just like that 2007 market peak we covered back in episode 1.2b. Remember? The S&P 500 had completely rolled over and started falling, all while the unemployment headlines were still glowing. So waiting around for a lagging indicator, you're basically just trading the past. Now, right smack in the middle, we've got our third bucket, which is coincident indicators. You can think of these as the mid-pack runners in our little data race. Data like personal income or industrial production, they reflect the current state of the economy as it happens, like in real time. They are confirming exactly what is going on right at this very second, kind of serving as a much-needed reality check on the current environment. Okay, moving on to section 2. The villains, the big 6 macroeconomic problems. So, what exactly are we scanning for with all this data? Well, every single release is ultimately trying to measure the risk of the big 6 problems. Let's walk through this list with some urgency because, honestly, these are totally critical to your portfolio. First up, recession. This drags earnings down across the board, no sector is immune. Second is inflation, which forces the Fed to hike rates, and as you learned in episode 2.2, that is absolute poison for stocks. Third, low productivity. This is pretty much the worst combination possible because it drives earnings down while simultaneously pushing inflation up. Next, budget deficits. These lead to higher interest rates and they actively crowd out private investment. Then we have trade deficits, which weaken the currency and act as a huge flashing signal for global imbalance. And finally, slow growth. This correlates with poor stock performance more directly than almost any other single factor on this whole list.
All right, let's jump into section 3, testing your data radar.
So, the crucial point is, how do we actually apply this stuff? Let's put your newly learned framework to the test with a real-world scenario. Quick check for you. Imagine you just woke up and read the headline, "Building permits just fell sharply." Is this a leading, a coincident, or a lagging indicator? And, more importantly, what is it telling you? Take just a quick second to lock in your answer. Okay, and the reveal. It's a leading indicator. See, because building permits signal construction activity months and months before a shovel ever even hits the dirt, a sharp drop is a massive early warning sign of slowing economic activity. It's telling you, hey, there's a problem here, well before it ever shows up in those lagging employment or GDP headlines. If you know it's a leading indicator, you know a recessionary signal might literally be flashing right in front of you. So let's pull all of this together. You now understand the whole leading, coincident, and lagging framework. You know those big 6 problems that every data release is secretly trying to measure behind the scenes. And honestly, most importantly, you can now confidently classify any new piece of economic data by which bucket it falls into before you decide how urgently you need to react to it. So you know how to classify the data. But when does it actually land? Well, in part 2 of this explainer, we're going to map out the exact master calendar. We'll cover which agency releases what, and on which specific day of the month it happens. So I'll leave you with this. How much more profitable could your portfolio be if you were simply never caught off guard by a surprise data release ever again?